Welcome to the Deep Dive, where we cut through the noise of earnings calls to bring you the essential insights. Today, we're taking a deep dive into the recent Q2 2025 earnings call for a major global commerce platform, and the market certainly reacted. A lot of enthusiasm, signaling some really strong underlying performance.
Indeed. Yeah, this call painted a picture of a company truly hitting its stride. Demonstrating consistent execution and a series of strategic pivots that are clearly resonating powerfully with investors. We're going to unpack exactly why these results stood out, looking beyond just the headline numbers to understand the strategic plays unfolding.
Absolutely. So let's kick things off with those headline numbers that had everyone talking. This past quarter delivered some genuinely impressive beats across the board, didn't it? Exceeding expectations on, multiple fronts.
You're right. The company reported GAAP EPS of $0.69.
Wow, 69 cents.
Yeah. And to put that in perspective, the consensus was just $1.14. So, that's a substantial beat.
Huge beat.
Adjusted EPS also comfortably surpassed expectations at 35 cents against a $1.29 consensus. These aren't just small wins. They signal a really strong operational quarter.
And on the top line, the revenue story was equally compelling, I thought. They hit $2.68 billion, right? Outperforming the $2.55 billion consensus by a solid 5%. And that marks a robust 31% year-over-year increase. That kind of growth at this scale is certainly eye-catching.
It absolutely is. And gross merchandise value, or GMV, it mirrored that strength. Grew 31% year-over-year to an impressive $87.8 billion.
$87.8 billion. Wow.
And their financial health remains strong, too. Free cash flow came in at $422 million.
Yeah, okay.
That translates to a 16% free cash flow margin.
16%.
And what's particularly noteworthy here, this marks their 8th consecutive quarter of double-digit free cash flow margins, so demonstrating a really consistent ability to generate cash.
8 quarters. Okay, that's a pattern.
Exactly. And monthly recurring revenue also saw a healthy growth, up 9% year-over-year to $185 million.
Okay, those are some undeniably strong headline numbers. Now, let's really unpack this phenomenal quarter. Let's dig into what's truly driving these figures, because like you said, it feels like more than just one good quarter.
Right. The narrative from management was distinctly bullish. They framed these results as the payoff from bold bets.
Bold bets. Okay.
Yeah, and when they talk about these bold bets, they're really referring back to strategic decisions made, maybe years ago. Things like their aggressive investment in building out their own payments infrastructure, or that determined pivot to attract larger enterprise clients, things that at the time might have raised some eyebrows about short-term profitability.
Maybe longer-term plays.
Exactly. Now, we're seeing those long-term plays truly materialize. We observe strong growth across all major verticals and merchant segments, and particular acceleration in key regions like the U.S. and Europe.
What's really compelling here is seeing that consistent theme you mentioned. Past long-term investments are now yielding significant returns. Management explicitly pointed to their sustained focus on powering both offline and B2B commerce.
Mm-hmm.
We saw offline GMV up 29%, which is great.
Pretty solid.
But the B2B GMV was, truly astounding, growing 101% year over year.
Yeah, 101%, more than doubling.
Incredible.
It truly underlines how effectively they've made significant inroads into attracting larger enterprise clients.
Mm-hmm.
I mean, this quarter we heard about iconic global brands like Starbucks, Canada Goose, Burton Snowboards, all migrating to the platform.
Big names.
Huge names. And this isn't just about adding new logos. It highlights the platform's incredible flexibility, its scalability, and that robust value proposition. It proves it can handle the complexity and volume of major global players.
Mm-hmm.
It really validates their years of investment in building out those enterprise-grade features.
And delving into their AI strategy. What were the standout announcements or initiatives there? That really caught my attention. Management stressed their aggressive rollout of Shopify Magic AI tools, positioning themselves at the forefront of what they call agent commerce. For someone who might be hearing that term for the first time, what exactly do they mean by agent commerce?
Right, agent commerce. So they're basically envisioning a future where AI assistants and chatbots don't just recommend products. They can actually facilitate the entire transaction, from the initial discovery all the way through to the final checkout.
So the AI is basically acting as a direct sales channel.
Precisely. Imagine an AI doing the selling. And to achieve this, they launched Shopify Catalog in Q2. This provides AI partners and shopping apps real-time access to millions of products via an API.
Okay.
And this isn't just, a new data feed. It's a critical move to open up their vast product ecosystem to these new AI-driven shopping experiences. It dramatically expands how and where merchants can sell, moving way beyond traditional websites.
That sounds like a pretty fundamental shift. And how does Universal Cart fit into that vision? I understand it's in early access right now.
Yeah, Universal Cart. So this basically allows shoppers to hold items from multiple stores in one place, within a conversation or across different AI environments.
Ah, okay.
So if you're chatting with an AI and find something you like from one store and then maybe something else from another, you can keep them all together. It's really about simplifying a buying journey, especially in these emerging conversational commerce channels, and just reducing friction for the consumer.
Makes sense. And the checkout kit really takes that a step further, doesn't it? It's already being used by Microsoft Copilot, I think, allowing partners to embed the merchant's checkout directly within their AI agent, complete with payment, tax, regulation handling, all that complex stuff.
Exactly.
They also highlighted Sidekick for merchants, which sounded interesting, an AI assistant offering instant data analysis for inventory optimization, churn analysis, campaign improvements. Plus, they've introduced an AI store builder. Apparently, it can create a custom online store in seconds from just a single phrase. That significantly lowers the barrier to entry for new entrepreneurs.
That's right. The checkout kit is huge because it ensures that seamless transaction within any AI interface, handling all the complex back-end details, like you said, and Sidekick for merchants.
Yeah.
Well, it means even a small business can have a powerful data analyst at their fingertips, optimizing their operations without needing deep technical expertise.
Yeah, democratizing data analysis.
Exactly. And the AI store builder, as you mentioned, it truly democratizes e-commerce, makes it incredibly easy for anyone with an idea to just launch a professional online presence almost instantly. So these AI initiatives, taken together, they represent a massive investment in the future of commerce, enabling both consumers and merchants to interact with the platform in fundamentally new, more efficient ways.
Okay, so beyond these fascinating AI developments, another area where this company is truly cementing its position is in payment processing. What did we learn about their financial services offerings this quarter?
Well, they've significantly expanded their payment product. It's now in 16 new countries this year, mostly in Europe. And that expansion contributed to their impressive global payments penetration, which hit 64%.
64%, that's high.
It is. They also introduced multi-entity support. This allows larger merchants, like Fiskars Group they mentioned, to manage multiple business entities from just a single shop. And that's crucial for complex international businesses. It streamlines their operations and makes the platform even more attractive to those larger players.
This raises an important point. What about payments innovation on the crypto front? I saw they added a USDC stablecoin option in partnership with Coinbase. How significant is that for, traditional commerce?
Yeah, this is actually a pretty significant step. It leverages the speed and lower fees often associated with blockchain tech. But crucially, by using a stablecoin like USDC, which is pegged to the US dollar, it removes that volatility risk you get with other cryptocurrencies.
Right, less risk for merchants and buyers.
Exactly. This makes crypto payments practical and secure for everyday transactions for both buyers and sellers. And it comes complete with traditional commerce features like authorized capture and refunds, plus a built-in off-ramp to convert back to local currency seamlessly. So it opens up new payment rails without the wild swings of, say, Bitcoin or Ethereum.
That's a clever way to bridge traditional commerce with crypto. Makes sense. And ShopPay just continues to be a standout, doesn't it? Its GMV surged 65% to $27 billion in Q2.
$27 billion.
Making it a go-to checkout for millions. And the Shop app itself saw incredible growth, 140% year-over-year growth in native GMV, 140%. Fueled by AI-powered search and personalized feeds, it's really positioning itself as a powerful direct-to-consumer hub, isn't it?
Absolutely. ShopPay's growth is just a testament to its frictionless user experience, which drives higher conversion rates for merchants. Simple as that.
Yeah.
And the Shop app, especially combined with its AI capabilities, it's becoming a genuine discovery platform. Think of it less as just like a shopping list and more as a personalized marketplace that learns your preferences.
Right.
Making it easier for you, the consumer, to find and buy from the millions of merchants on the platform. It's a really key channel for direct engagement.
And on the offline front, their point-of-sale business saw GMV up 29%, driven by larger retailers, they said. The redesigned POS app, new features, and that landmark deal with Canada Goose to power 50 of their physical stores starting in 2026. All of that reinforces their strength in unified commerce. It really shows they're not just an online play.
Not at all.
Yeah.
That Canada Goose deal set to roll out in 2026, it's a huge vote of confidence in their ability to handle complex omni-channel retail operations. It signals that even high-end global brands are entrusting them with their physical store infrastructure, truly blurring the lines between online and offline for merchants and consumers. Their ambition for unified commerce is clearly translating into real-world wins.
So what's driving this incredible international growth, especially in Europe? We saw GMV up 42% on a constant currency basis there.
42%, yeah.
And merchants outpacing the broader e-commerce market by 4 or 5 times. They also highlighted strong performance in Asia Pacific too.
Right. It's not just, organic market expansion riding the wave. Management spoke specifically about their targeted investments, things like localized payment solutions, region-specific marketing campaigns, dedicated support teams. It demonstrates a pretty sophisticated approach beyond just translating their platform.
Tailoring it to the market.
Exactly. They're customizing their offering to meet the unique demands of each market. And that allows their merchants to grow significantly faster than the overall market. This tailored approach is clearly paying off.
What's particularly fascinating, I thought, is how they're also winning upmarket. Beyond just the widely known consumer brands, they highlighted signing a global leader in mining drilling services, Bort Longyear. That's quite a departure from a typical retail client, isn't it?
It is, yeah. And it's an incredibly important data point, I think. The Bort Longyear signing clearly signals a strategic move beyond traditional retail. This isn't just about selling T-shirts or, consumer goods anymore. It demonstrates the platform's scalability and flexibility to handle complex B2B transactions, even in heavy industrial sectors.
Right. Broadens the scope significantly.
Hugely. It significantly broadens their total addressable market and really validates their enterprise strategy. It proves their technology can serve a much wider array of business models than perhaps people initially perceived. It positions them as a kind of foundational commerce layer for almost any type of business.
Okay, so looking ahead then, what did the Q3 guidance project for the next quarter?
Q3 guidance projects revenue growth in the mid to high 20% range year over year.
Mid to high 20s. Okay.
Gross profit dollars are expected to grow in the low 20s. And operating expenses projected to be around 38-39% of revenue. Free cash flow margin is guided to be in the mid to high teens. So still pretty solid numbers, especially considering their scale.
And a key takeaway from the CFO, I noted, was their focus on driving growth, not optimizing for near-term margin.
Yeah.
Which highlights their view of the long-term growth opportunities ahead. And they also confirm their long-term ambition for a 20% plus free cash flow margin. That's a significant target down the road.
It is. It tells you they are prioritizing market capture and building out their full suite of services right now. They believe the profitability will follow as they continue to scale. Notably, they also mentioned that macro headwinds, like tariffs, didn't really materialize as a significant impact this quarter, which is obviously good news.
Good to hear.
And on the financial health front, the company plans to settle a $920 million convertible note principal entirely in cash.
With cash? Wow.
Yeah, demonstrating considerable financial strength and, importantly, a commitment to minimizing shareholder dilution. It really shows confidence in their cash-generating ability going forward.
Okay, so after diving deep into the results and all these strategic initiatives, what does all of this mean for investors? The context around these results is key to understanding that overwhelmingly positive market reaction we saw.
Well, yeah. The company's total return over the last month, quarter, and year has just significantly outpaced the S&P 500. We're talking about 137% return over the past year compared to the S&P's, 23%?
Huge outperformance.
Massive. And this performance wasn't entirely out of the blue either. It was fueled by some pre-earnings chatter about those enterprise wins and tantalizing AI product teasers even before the call. So anticipation was building.
And the market's immediate response was really striking, wasn't it? The share price jumped 19% within just 30 minutes of the market open.
19%, yeah.
And turnover spiked more than 3 times the 30-day average. They mentioned short-dated $160 strike calls led the options flow, which indicates extremely strong bullish sentiment, right? For those maybe less familiar, that means a lot of traders were placing large short-term bets that the stock price would surge past $160. Reflects very high conviction.
Exactly. Extremely high conviction. And while, some sell-side analysts did note concerns about potential margin compression in certain areas or maybe some accounting noise. The stock action clearly signaled that investors are prioritizing that robust top-line acceleration and the compelling growth narrative above all else right now.
Yeah, the market's looking past the short-term nuances to the bigger picture.
That seems to be the case.
This deep dive really reinforces the company's strategic pivot, I think. They've truly evolved from being primarily an SMB-centric software provider to becoming a genuinely full-stack global commerce infrastructure player. And their execution discipline, which you can see in operating expenses growing slower than revenue, that points towards expanding operating leverage. Meaning, basically, their profits should grow faster than their revenue over time, given their fixed cost base allows for that scaling.
Right. And moving forward, investors will be closely watching three main catalysts, I think. First, that September launch of end-to-end checkout extensibility for large merchants.
Okay, explain that a bit more. Why is that so key?
Well, this is huge because it gives enterprise clients the really granular control and customization options they demand for their checkout process, something this company historically struggled to offer at that scale. It finally brings true enterprise-level flexibility to their platform in that critical checkout stage.
Got it. Makes it more appealing for the big players. What's second?
Second, we'll be looking at the holiday season GMV read-throughs. Historically, those numbers swing sentiment significantly for retail and e-commerce stocks. A strong holiday season would really validate their AI tools and that big enterprise push we've been talking about.
Right. The proof is in the holiday pudding, so to speak. And third.
And finally, there's a December Investor Day planned. Management is expected to outline a medium-term framework targeting that 20% plus free cash flow margin, really cementing their long-term financial ambition and giving investors a clearer roadmap.
Okay, three big things to watch. Check out extensibility, holiday GMV, and the December Investor Day FCF targets. All right, let's switch gears now for our This Is Not Financial Advice segment. Based on this very strong call and the market's undeniable reaction, let's brainstorm an outrageous but plausible trade idea. Something you might pitch to a hedge fund investment committee, something that would make them sit up and take notice.
Okay, outrageous but plausible. Given the confirmed strength in Europe, that accelerated GMV growth there, and management's explicit commitment to international expansion, an interesting idea could be to look at long-term call options on this stock, specifically targeting a significant upside move after the holiday season, maybe leading into that December Investor Day.
I like it. Playing the catalysts. Let's get more specific then. With the September launch of checkout extensibility, potentially boosting attach rates for large merchants, combined with management's bullish tone about the holidays, plus that upcoming December Investor Day with the projected 20% plus FCF margin framework. Okay, here's a thought for that hedge fund committee. Buy a January 2026 $180 call option.
Ooh, January 26 $180 calls. That's certainly aggressive. I mean, the stock's already had a significant run-up, and that strike price suggests a substantial further increase is needed just to break even, let alone profit.
True, it's aggressive, but think about the compounding effect of these catalysts. If checkout extensibility really proves out, becomes that sticky, high-value offering for large merchants they believe it is, that's a new, powerful revenue driver.
Yeah.
Then you get a strong holiday season read-through, maybe fueled by widespread adoption of their new AI tools. You could see GMV numbers truly explode. And finally, a definitive long-term FCF margin target at the Investor Day, one that outlines a clear path to significant profitability that could lead to a definitive re-rating higher by the market.
So you're betting on multiple positive catalysts hitting in sequence.
Exactly. The market has already shown it's willing to price in future growth and operating leverage. This trade isn't really about incremental gains. It's about betting on the collective force of these strategic initiatives driving the narrative, and that potential re-rating higher as those long-term FCF targets come into clearer view. It's an outrageous bet, yes, but it's a bet on this company's ability to keep delivering that generational company consistency, leveraging its foundational role in global commerce.
Provocative. Okay, so to recap then, this earnings call painted a pretty clear picture of a company executing on all cylinders, from aggressive AI innovation to significant international and enterprise expansion.
Yeah, their disciplined growth, strong cash flow generation, and that clear strategic roadmap. It really suggests they are indeed building for long-term durability, cementing their position as a truly pivotal player in the global economy.
Absolutely. But as always, remember that everything discussed today is strictly for informational purposes only. It is absolutely not financial advice. Please do your own research, consider your own circumstances, and consult with a qualified professional before making any investment decisions.
Well said. We hope this deep dive gave you some valuable insights and maybe prompted some new questions for your own research. If you enjoyed this, be sure to subscribe to the deep dive for more earnings call breakdowns and strategic explorations. Until next time, keep learning and stay well informed.